Welcome to ECN Trade Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. Hello everyone, my name is Rob Clayton and thank you for joining me. Well, since the rebound of 64.80, the Australian dollar has managed to rally further as the weaker ISM service report out of the US led to a broad decline in the US dollar, despite the Institute for Supply Management data showing a second consecutive drop in non-manufacturing PMI to 51.4 in March, indicating moderate expansion in the US economy, while the ADP data revealed private payrolls surpassing expectations, reaching 184,000 in March. However, exceeding the figure of the forecast of 148,000, and with the previous month's figure standing at 155,000. This week, the focus is on the upcoming US job report as investors closely monitor indicators and statements from the central bank's officials. Elsewhere, Fed Chairman Powell said at Stanford University many Fed members supported a rate cut but were waiting for clearer signs of lowering inflation. Delaying rate cuts could, however, worsen the economic conditions. With recent strong economic data has created uncertainty about the timing of the rate cuts, despite expectations for June. In February, annual inflation stood at 2.5%, down from its peak of 7.1% and closing in on the Fed's target of 2%. So with all eyes on the non-farm payrolls, let's see if the dollar does weaken as it dropped away from its peak of 105.15 to 104.20 in New York this morning. If this continues, then the Australian dollar should eventually reach its objective around 67 to 68 cents in the broader aspect. Moving on to the euro, the market has extended its gains since its rebound closed at 107.1525 and now looks closer to that 108 to 109 to 110 objective. If the dollar does weaken further, which I do anticipate, then this strength should extend on, like previously seen from this bottom here, rallied on to 111. The bottom also 107, rallied on to close to 110. So I do expect to see history repeating itself and see the current pattern extending. Looking at the dollar yen, the market is still somewhat directionless as it hovers beneath the potential intervention level that was seen around 152 back around 1990. Nevertheless, with bearish divergence, an overheated ADX trend indicator and a declining MACD to support some divergence in the current price to a bearish factor, could see the market eventually take a significant fall. To support the outside range day, we do need to see a break of 150.50 to ignite the move lower to 149 and reassess. Following the rest of the patterns, sterling has surged and has erased the losses earlier this week and now looks towards 126.5 to 128 as a potential broader target, with the technicals firming does support this view. Refreshing its highs, gold reaches 2,300 overnight and now puts a bit of a question on how high it can continue, that is, due to the extreme overbought conditions and an overheated ADX. Although I hold a neutral view, traders should continue to exercise caution due to the upcoming sensitive data and adjust strategies according to their risk management, as we may see further whipsaw price action and maybe even a potential pullback to around 2,250. Finishing up with oil, the market continues its extension from $83 and therefore leaves me little or no clear view from the upside. But saying that, let's see if the market can pull back, as it is showing some divergence and an overheated trend, and therefore could look back towards the region of $83 a barrel, or maybe lower to around 81.60. Well, that's a wrap. Thank you for joining me, and as always, look out for the intraday report. I hope you enjoy the great start to the day.